A stocktake is a common business practice, but when the time comes to evaluate your internal controls, what to do, an audit is one such enterprise.
What does it mean to have strong internal controls to safeguard the company and its assets?
Good question, Chris. Businesses are often vulnerable to fraud because they don't have effective internal controls. You could paralyze your business trying to cover every possible contingency. However, by removing opportunity and motivation for fraud and theft, and ensuring you have systems in place to discourage errors and identify mistakes and anomalies quickly, you're able to discourage fraud in the first place. And if that fails, you can take corrective action to minimize losses. Owners and managers hold the key to the fight against internal control failures and must be attentive to the concept and issues of internal controls to maximize the business potential and minimize the risk of fraud, error, and loss. Internal controls are methods or procedures adopted in a business to safeguard a company's assets, ensure financial information is accurate and reliable, ensure compliance with all financial and operational requirements, and generally assist in achieving the business objectives. Developing and implementing an internal control environment that reflects your company's values, especially if your values feature preventing fraud and creating a harmonious environment, is vital to the overall health of your company.
I've been told my company might have reporting obligations to ASIC and I may require an annual audit. What does this mean?
Yeah, it's a good question. Although all companies should keep adequate financial records to ensure they're fully informed of their financial performance and financial position, some types of companies need to keep these records for the purpose of preparing and lodging financial reports with the Australian Securities Investment Commission, also known as ASIC. A company's financial reporting obligations depend on the type of company it is. Your friend may have been referring to your company perhaps being a large proprietary company. Firstly, it's important to understand what a large proprietary company is defined as. From financial years commencing on or after 1 July 19, a proprietary company is defined as large for a financial year if it satisfies at least two of the following criteria. The consolidated revenue for the financial year of the company and the entities it controls is 50 million or more. The value of the consolidated gross assets at the end of the financial year of the company and the entities it controls is 25 million or more. And finally, the company and any entities it controls have 100 or more employees at the end of the financial year. Large proprietary companies must prepare and lodge a financial report and a director's report for each financial year. The accounts must be audited unless ASIC grants relief. If the company does not meet at least two of the above criteria, it is considered small. In some circumstances, small proprietary companies may also have to lodge financial reports.
It comes with a fearsome reputation, but rather than looking at an audit as something to fear, view it as an opportunity to revitalize your organization through the identification of blind spots. Addressing the delivered findings is one pathway to eradicating inefficiencies and achieving sustainable success.